Thank you guys so much for joining. Once again, this is Timewise Financial's webinar on equity compensation, hosted by Caroline Piehl. My name is Kimani Woods, and I am the communications manager here. We're so excited for Caroline to host this webinar on equity compensation because she has worked for corporations such as Nike and the North Face and has a personal experience with this, as well as her financial planning knowledge on top of that. So she is definitely going to help break down equity compensation in a way that is easy for you all to understand. And as well, she's going to be talking about the tax implications and then giving you a checklist as well that will help you as you continue on. So thank you so much, Caroline. You are ready to go.
Alrighty. Thanks, Kimani. Good morning, everyone, and good afternoon to those on the East Coast. I want to thank you guys for joining and taking time out of your day to learn a little bit more about your equity comp. At Timewise, we fundamentally believe that our job as advisors and planners is to educate you so that you can make the informed decisions regarding your finances. So our goal today is to give you the knowledge and the tools to better understand your equity compensation, as well as a framework for how to make decisions. Our role is not to tell you what to do, but to provide you with the knowledge and the guidance so that you can make those informed decisions yourself. So I first want to start off with just a quick self-assessment. If I asked you how you currently feel about your equity compensation when it comes to your level of understanding, if you're feeling more like the person on the left, then my goal is by the end of this webinar that you at least feel a little bit more like the person on the right. So let's get into it. I'm a big believer in always starting with why and understanding the why. So when it comes to equity compensation, why do companies offer it? The essential premise is that by granting equity to employees, the company is essentially tying your work ethic as an employee to the company's revenue and the company's output, which aligns the employee's incentives to that of the company's. It's also a more flexible way for the company to pay you as an employee, rather than having to free up additional cash in the company to pay you. They're paying you by issuing stock. So they can use that cash to reinvest in the business, to pay expenses, etc. So that's a bit of a backstory of why equity compensation exists and the incentive of the company. But in terms of how it relates to you, oftentimes we see people approach their equity compensation on an ad hoc basis. They make decisions in a vacuum, or they have no strategy at all. But not you guys, because you showed up to our webinar. So today we'll cover the two most common forms of equity compensation: RSUs and non-qualified stock options. And then we'll also go over a couple of best practices. Now, it's important to note that I'll be speaking to the general rules and strategies for equity comp, but it's really important to know that your specific company has rules and nuances that apply to your specific plans, such as years of service, income, your employee status, what your particular vesting schedule is, any blackout periods. So the biggest takeaway for you, my hope is that you will locate your grant documents and get familiar with the specific rules and regulations that you're subject to. So starting first with RSUs, it's important to understand what a restricted stock unit is. And an RSU is not actually shares of your company's stock. It's simply your company's promise to give you shares of the company stock at a future date based on, if you meet certain conditions. So think of RSUs as an IOU from your company. And because of the way RSUs are structured, they hold no actual value at the time they're granted. So let's say you sign your offer or you accept this new RSU grant, you don't actually receive anything yet. But once the RSUs vest, that's when you actually receive the shares of your company. And the value you receive is equal to the market value of the stock on that vest date. So this value you receive on the vest date is fully taxable to you on the date of vesting at both the federal, state, and local level, and is also subject to Social Security tax. So it doesn't matter what the price of the stock is on the grant date or any other date. The only price that matters when it comes to RSUs is the price at the date of vesting. So it says if certain conditions are met. The primary condition when it comes to RSUs that you have to meet is the vesting schedule. And the most common types of vesting schedules are time-based and performance-based. So time-based is typically somewhere between 3 to 5 years that you're with the company, with a portion of your RSUs vesting each year. Performance-based, which are sometimes called performance stock grants or growth share units, these don't vest until you or your company meet certain targets or milestones. There's also a few special circumstances that impact your RSU vesting schedule. So number one is termination. If you quit or you're laid off or you're fired, generally most companies treat a termination where any unvested shares are forfeited. So you lose those unvested shares at termination. If you retire, there typically is a window post-retirement that companies allow RSUs to continue to vest. For example, let's say it's 3 years. So let's say you retire, you still have 3 years for some of your unvested RSUs to vest until the rest are forfeited. And then lastly, for death and disability, most companies have immediate vesting upon death or disability. But again, for all of these special circumstances, it's going to be really dependent upon your company's documents and how they lay out their terms. So once your RSUs vest and those shares are delivered to you, they're generally treated no different than a normal stock that you might own. You've paid taxes on the vest date, but then you now hold the shares of the company. And so it's up to you to decide whether you want to hold those shares or whether you want to sell them and use the proceeds for something else. Now, there are some companies that have blackout periods, which essentially is a window where you're not allowed to trade the stock. So you'll have to look out for your specific scenario if your company has a blackout period, because you won't be able to sell the stock during that window. And once you sell the shares, it'll be treated as a capital gain or a capital loss, depending on the stock price when you sell, if it goes up or if it goes down from the vest date and the price at the vest date. And it'll either be treated as short term if you hold it for less than 12 months or long term if you hold it for more than 1 year. So let's take an example. I worked for Nike, as Kimani mentioned, so we'll use Nike as an example. Let's say in this scenario that Nike grants me 100 RSUs. There's a 3-year time-based vesting schedule. So as I mentioned, there's zero value in 2017 when these are granted to me. There's no tax implication. It's just the IOU contract I receive. 3 years later, my RSUs are fully vested. So Nike now delivers those 100 shares to me. And the full market value on that date is taxable to me. So the market value on September 1st, 2020 was $134 per share. So I now am adding $13,400 to my W-2 in 2022, which is subject to federal, state, local, and Social Security tax. Whether or not I sell them or keep them, I still have to pay that tax, which a lot of people get hung up on. But in this specific scenario, I decide to hold on to the shares because, I don't have a lot of other Nike stock. I'm well diversified in my other investments, and I don't really have a need for cash. So I'm going to hold on to them for a year. And then 2021, I sell all of the shares. The stock price is $169 per share. And now I'm only responsible for the gain since the vest date because I already paid taxes on that full amount on the vest date a year ago. So stock price went up. I owe long-term capital gains tax on the difference between the two, which in this example is $3,500. Now, long-term capital gains tax rates are more favorable than your ordinary income tax rate. Depending on your income or your joint income, if you're married, capital gains tax rates for you are either 0%, 15%, or 20%. Compared to income tax rates, which can go as high as 37%. So hopefully this example helped give a little bit more clarity in terms of what decisions have to be made and when I should sell the shares, as well as the tax treatment along the way. I do want to click into just one step further on the tax planning side of RSUs. And the biggest takeaway for RSUs is that the vest date equals taxes due. And so your employer may have different rules around withholding. Some may require you to withhold a certain percentage, and some may not allow you to withhold more than 22%, which we see most commonly. And so a best practice that we use with our clients is to surrender a portion of your vested shares to cover those associated taxes. So in that previous example, let's say that, Nike doesn't allow me to withhold any more than 22%. And so they're going to withhold 22%, and I elect the option to surrender a portion of my shares to cover the taxes. So essentially, Nike will hold 22 shares and only deliver 78 shares of stock to me. And so that will cover off on either a portion or all of the tax liability that I owe, depending on my tax rate. So the big caveat here is if your tax rate is higher than 22%, and that's all you're allowed to withhold, then you will have underpaid in taxes, and you will require some additional tax planning. So if this is your scenario where you're above the rate that your company allows you to withhold, then we would encourage you to work with, your financial advisor, your tax advisor, to plan out, what your tax estimate will be. So that's RSUs in a nutshell. We're staying pretty high level, but we really want to focus on just the core components of RSUs as well as how they're taxed. Moving on to stock options, I'll only be referring to non-qualified stock options because they're more common. But if you have incentive stock options or ISOs, the tax treatment is different, and we won't be covering it today. But if you have questions on it, I'm happy to talk with you and meet to discuss your specific scenario. So stock options in the simplest form give you, the employee, the right or the option to buy company shares at a fixed price. There's a lot of different buzzwords that are used for this fixed price, exercise price, strike price. But just think of it as you have the option to buy shares of your company at a fixed price for years in the future. And you must do this before the expiration date. So typically, stock options expire somewhere between 7 to 10 years. And they also have a vesting schedule that typically spans 3 to 4 years. So when the options are granted to you, there's no value and no taxes due. But once they vest, you now have the option or the right to purchase the shares at that fixed price. And then you can sell shares at a later date to realize that taxable gain. And so you have to exercise before they expire, or else you'll lose the options entirely and any value associated with them. So once they've vested and let's say you decide to buy shares at that fixed exercise price, therefore exercising the options, in the eyes of the IRS, the value that you have received because of this benefit is the current exercise price or the current stock price when you exercise, minus that fixed price that was quoted in the grant. That is the gain or the appreciation amount that the benefit that you are receiving, and is therefore treated as taxable income. So for options, when you exercise, that spread or the difference between the current value and the exercise price is the taxable income that you will incur. So once you buy the options, you can either immediately sell them, or you can hold on to the stock and sell at a later date. So what we see most clients do, and most people in general, is they choose to do a cashless exercise, which means you simultaneously are buying shares at that fixed exercise price, and then you're immediately selling them at the current market value. So that means you receive that difference between the current value and the exercise price, compared to, let's say you waited a year to sell the shares that you bought. You would buy at that fixed price, hold for a year. That means that you have to have the cash sitting aside to be able to buy the shares up front, and then you don't get to actually receive the cash back until a year later when you sell. Whereas a cashless exercise doesn't require any upfront cash. You just receive the spread, the difference between the current price you sell at and the fixed price that you bought at. And so that spread is treated as taxable income at ordinary income tax rates, which I mentioned span from 0% all the way up to 37%. So stock options can be a little bit more tricky. So I want to give an example here. Let's say, it's me again back at Nike and they grant me 100 non-qualified stock options. The exercise price, or that fixed price, is $40 per share. They vest in 3 years and they expire in 10 years. So it's not until 2017, 3 years later, that my options are vested and I can now purchase Nike stock at $40 per share until 2024. And so, as you can see with options, you have a lot more flexibility on when you want to exercise the option. So let's say in 2020, I want to exercise my options because I want to buy a new home. And the price of Nike stock in September of 2020 was $135 per share. And I decided to do a cashless exercise. So I simultaneously buy Nike stock at $40 a share, and I sell those 100 shares immediately at $135 per share, which is the current price. That spread is the money I receive and the money that's subject to federal, state, local, and Social Security taxes. And in this example, that spread is the value I receive is $9,500 and is treated as ordinary income. Now, $9,500 won't get me very far in buying a house, so maybe I'm just remodeling a bathroom. But as you can see here, stock options, as I mentioned, they allow for a lot more tax planning opportunities and strategy on when to exercise, your certain grants of stock options based on your income, based on your combined income. For example, if your spouse has a really big year in their job and their income doubled, let's say, might not be the best year to exercise your stock options because you're going to be adding the value of those options to your taxable income that year. It also depends on your tax rate, your short-term goals, or if you have a need for cash, as well as how your stock options fit in with your RSU schedule and when they vest, if you also have RSUs. So there's a lot of different things to consider in terms of timing to exercise options. But the biggest biggest takeaway for options is that you have to take action to exercise. And you also get the choice of when you exercise and therefore how much income you're going to be recognizing in that year and how much tax you're going to have to pay. If we compare that to RSUs, you have no control over when you recognize the income and when you're liable to pay the tax. If you remember with RSUs, once they vest based on your vesting schedule, the full amount is taxable to you in that year. So there's less active participation in RSUs and less control, whereas with options, there's more control and more flexibility of when you're realizing the income. One downside to stock options is that they can become worthless. So let's take this exact example. And let's say 10 years later, the stock price of Nike was $39 per share. Essentially, my stock options would expire worthless. Now, while that's highly unlikely for a company like Nike, it is much more common for startups or smaller companies in extremely volatile industries such as oil and gas. And so this is an added risk for stock options. Now, I've sprinkled a few strategies throughout, but I want to go deeper into some of the key areas that we work with. But these are going to be general approaches. They don't factor in any company-specific regulations, terms, or restrictions. And it also doesn't factor in any other tax implications from outside income you have, income your spouse has, whether you have rental properties. We're solely isolating the treatment of equity compensation so that you can understand the concept and how they generally work. So we touched on this a little bit, but let's say, your company only allows you to withhold 22% for your RSUs. And let's say you're in a 37% federal tax bracket. That means you're still going to owe 15% on that fully vested balance for your RSUs in the current year. And so a solution that we deploy with our clients is we set up estimated tax payments in the quarter that the RSUs vest. So rather than waiting until next April to pay and accruing those underpayment penalties, we set up estimated payments in the quarter that the RSUs vest. So this is a general best practice. Another method is increasing your salary withholding to cover that tax gap. Another common topic that we have is whether or not and when to sell the shares once your RSUs vest. So if your vesting schedule, that schedule that your employer lays out, is overlaps with when you can trade. So if you don't have a blackout period, essentially, it can be advantageous for you to immediately sell the shares when they vest in a couple of different scenarios. Number one, as I just mentioned, if you're under withheld in your taxes and you need cash to cover that tax estimate. So let's say you still owe 15% and that 15% is $15,000. If you don't have $15,000 sitting on the sidelines to pay that, a good practice is to sell some of those shares or all of those shares to cover the tax bill. Another scenario where it could be advantageous to sell the shares is if you have a concentrated stock position. So if you have too much of your overall wealth in your company stock and you either need to or have a desire to diversify your portfolio, then selling shares immediately when they vest can also be a good practice depending on the situation. And then it just comes down to if you have a need for cash, whether it's for a down payment, if you want to pay off debt faster, or if you want to get into another investment, it can be advantageous for you to sell those shares immediately because you'll be able to use the proceeds when you sell, and then you won't have to pay, you'll pay little to no capital gains tax because you're immediately selling as they vest. So obviously all of these, these aren't blanket statements. It really depends on your specific scenario, but in general terms, these are worth considering and talking further. So as certain situations become more complex where you have both RSUs and stock options, it really goes back to the pros and cons of each type and making sure you're looking at your equity compensation as a whole. As I mentioned, stock options give you more flexibility on when you're realizing the income and when you have to pay taxes, but they do require you to make that decision and actively exercise them. And they also have that risk of becoming worthless. RSUs, on the other hand, you don't have that flexibility on when you will recognize the income and have to pay the tax. And so that's something else to consider as well. But regardless, the most important thing to do is to look at the vest dates and the expiration dates for RSUs and options and overlay them to look at year by year what your estimated tax implication is going to be. So a couple things to keep in mind if you have both RSUs and stock options. Number one is that you have to exercise options before they expire, or else you'll lose the value. But it's important to be mindful of looking at, if you have RSUs, when are they vesting? And if you have RSUs vesting in the current year, you might want to consider or reconsider exercising your options because you'll just be adding more taxable income for that year. And then the second thing to look at is in terms of when to exercise your options and looking at your RSU vesting schedule is if you're retiring or leaving a company, there's something called a post-termination exercise window, which is essentially just the window of time after you retire that you must exercise your options or else they're forfeited. And so if you didn't do any sort of proactive planning, you essentially have to exercise your options within that window, which we most commonly see 90 days post-retirement as the window. Whereas if you proactively, exercised a portion of your options in each of the 5 years leading up to retirement, you could have spread out some of that tax liability. So it's not all hitting you in 1 year, in the year that you're retiring. And so if this sounds like your scenario, we highly recommend that you are working with a professional to map out the year by year overlap, as well as the estimated tax implications and strategies to lower your tax liability. Another common question that we always get is around concentrated stock, or do I have too much in Nike stock or Visa stock, whatever your company is. The general rule of thumb that's kind of widely shared across the industry is that a concentrated stock position is if more than 10% of your total assets are in one single company. Now, there's a lot of different sources of company stock, obviously RSUs, stock options, ESPP, which is essentially just discounted stock for employees. So there's a lot of different ways where you can accumulate a lot of your company stock. So let's say you have $1 million portfolio and you have 100,000 or more in one single stock. That's considered a concentrated position. If that stock went down 50%, it has a much bigger impact on your overall portfolio. Now, this isn't an exact science, so there are a few things to keep in mind and consider as you're looking at whether or not to unwind your concentrated position. And the first is just fundamentally pointing out the difference between concentration and diversification. If you have a salary, equity comp, and a concentrated stock position in one single company, you're putting a significant part of your financial well-being in the hands of one company. So it's a lot of your eggs in one single basket. And even the best companies have unexpected events occur. Facebook, for example, was down somewhere near 80% last year. And the whole premise of diversifying is that you have a winner in your portfolio every year, no matter what the market conditions are. And it's not about having all or nothing in concentration or all or nothing in diversification, but just a balance of the two. And what's best for you is really heavily dependent upon your tolerance for risk and the phase of life that you're in, which often go hand in hand. So let's say you're 28 years old, you have 30 years plus until retirement. So you have a high risk tolerance. Keeping 25% or 40% of your assets in one stock might be the right fit for you. On the other hand, if you're 55 and you're retiring in 5 years, unwinding your stock position to be less than 10% of your assets, might be the right fit for you because you don't have as much time to recoup losses if something unexpected were to happen to that company. The other thing to keep in mind is, do you need cash in the short term? And what is the purpose for that cash? So if it's, having cash to fund a specific financial goal, selling some of your concentrated stock might be the right move for you. If selling shares of the stock will, to buy a boat will bring you closer to financial fulfillment, then unwinding the position is probably the right move for you. And then the last thing to consider is, as you go to sell shares of your company stock, it's really important to look at the tax implications of which shares you should sell. If you sell shares that just vested or you just bought within the last year, it'll be treated as a short-term capital gain or a short-term capital loss. Short-term capital gains are treated as ordinary income. So that's your higher tax rate. On the other hand, a short-term capital loss, you can use dollar for dollar to offset your income in the current year up to $3,000. And then you can carry forward that loss into future years. If you chose to sell shares that were vested or purchased more than 1 year ago, then it's treated as a long-term capital gain or a long-term capital loss. And so if it's a long-term capital gain, as we discussed, it's that 0%, 15%, or 20% tax rate based on your income. And then if it's a long-term capital loss, then you can use that full loss to offset any capital gains in the current year, as well as use $3,000 of the loss to reduce your taxable income for the year. And then you can also carry forward that loss indefinitely into future years. So a lot to consider with concentrated stock, and each situation is highly nuanced to your specific situation, your tolerance for risk, and your general outlook on how much risk you want to take on in the phase of life that you're in. This is just a kind of a PSA. It's something that's more common with smaller companies or startups, but it's worth sharing. There are some custodians of equity compensation plans that are notorious for either entering in incorrect or have missing cost basis on the tax forms. And your cost basis is essentially the amount that you paid for the stock, the amount that you've already paid taxes on. And so when you go to sell shares of that stock, that's how they calculate how much your capital gain or your capital loss is what you sell it for minus what your cost basis is. And so tracking cost basis is really important. And if you're using TurboTax, there's a very high possibility that this error won't be caught. So make sure you're reviewing this with your tax preparer, with your financial advisor, and just be on the lookout for this. So that's it for today. As a follow-up and a thank you for attending, we will be sending out both a link to the webinar as well as this equity comp checklist. So I went over broad strokes how certain types of equity comp works, as well as some strategies. But as I mentioned, it really is more about you becoming familiar with your specific plan. And so this is a checklist of certain things to look through your plan documents and make sure you're familiar with. But if you have any specific or general questions on your situation, I'd love to talk to you. So shoot me an email or give me a call, and we can discuss. So thank you guys for joining. Here are some required disclosures, and we'll see you next time.